Hi everyone, welcome back to chapter 14. This is the second video. This is it's sample lab problems, not the ones you were assigned, but similar. The first one we're going to do has a discount, in other words, it's sold for less than face amount. And then in video 3, we're going to do one that's sold for more at a premium, so you can have a feeling for both. Because most of the homework is pretty much on these things. So the first one, and I put it all on the board because that seemed to work so well last time for the previous chapter, because it's so much neater when I don't have to write when I'm talking up here. So what I did is separate it into the two requirements. By the way, this is on page 792, it's 1440B. And in requirement 1, they ask you A, B, C, D questions pertaining to the problem. And the problem is, Johnny's Hamburgers issued 8% 10-year bonds payable at 85, which means 85% of face. So they sold at a discount. They actually sold for 85% of 300,000, which is right here, 355,000. So a $45,000 discount. Okay, I'll get to that part in a minute. I did all the math ahead. Again, so you don't have to wait for me to do it, and I can just explain it as we get to it. I think that that's probably flows better. So, they reported the bonds payable as follows, and you see bonds payable, 300,000. And this is as of December 31st, 2020. They like doing this. They like showing you what it looks like in a couple of years and then asking you questions about it. This is 2 years later, December 31st, 2020. Bonds payable, of course, at 300,000, less the discount on bonds payable. That's the unamortized discount. Again, I have the T account here. Okay. And that's where the 36,000 comes from. Here's the discount. Discount on bonds payable is contra to bonds payable. In other words, it increases on the debit side. Okay, bonds payable is a liability, so it increases on the credit side. The discount is contra. So we have the $45,000 discount because remember it sold for 85% of face amount, and that was $255,000. That leaves the discount, the difference between the selling price and the principal or face amount. So I did each amortization of the discount, $22.50, 2 times a year. They're semi-annual payments. And these bonds are 10 years, so it's going to be 20 payments. If I can find, here we go. Here's the $45,000 total discount, 20 payments. You multiply the number of years by 2 because they're all semi-annual discounts. Probably 99% of them, if not 100%. So that's where the $22.50 every 6 months comes in for the amortization of the discount. We use straight line amortization, it's always the same. If we had to do all 20, they'd all look alike. We only have to do one journal entry here in requirement 2. That's it. So anyhow, that's the story, kind of the background of what's going on in this problem. So I'm going to get to the math as I go along. A is what's the maturity value? That's really the easiest question. It's the face amount. Remember, bonds are 2 streams of money. The principal amount that's paid at the maturity time of the bond, maturity date. Of course, it does not have to be held to maturity. It can be sold on the market. More about that in the chapter. As we discussed in the first video, the company can actually buy back the bonds if they're kind of sick of paying the interest payments, or the bonds are selling cheaply and they think that they can actually have a gain on that, like we talked about in the first video. But this one isn't like that. This one's just a straight to maturity. So we have the maturity value of 300,000. That's a very easy question. B, they want to know the carrying amount of the bonds at December 31st, 2020. Well, they kind of gave us that answer. There we go again with the phone. How that comes about is the 300,000 and then the $36,000 An amortized discount. Again, we've amortized it 4 times, so that comes to $9,000 if you add up the 4 amortizations. But it's actually right there in the problem for you. You see less discount, $36,000. So the carrying amount of the bonds right now after 2 years is $264. That's where this answer comes from. But even if it wasn't there, it still would be easy to figure out. Okay? I find these little T accounts very helpful. Of course, here they actually tell you the answer right within the problem. So answer C, we need to have, what is the semi-annual cash interest payments on the bond? Notice they say semi-annual. So the book is very fond of using the annual rate times 1/2 or 6/12. I learned it by cutting the interest in half, so I used 0.04. So I kind of always do that, but the book likes to do the half of the annual rate. It comes out the same. So every 6 months, the annual interest payments are $12,000, which would be $24,000 per year. Okay? 8% of this would be $24,000. Half of that they would get, your bondholders would get $12,000. And they're going to get this 20 times if they hold the bond to maturity. So that's answer C. Answer D, a little bit tricky. What's the interest expense the business, the company, corporation should record each year? Okay, that you might say, well, it's what they pay. But again, within the chapter, and we talked about it in the first video, or I talked about it, that when you have a discount or a premium, it changes what's recorded. We know that they are paying $12,000 every 6 months, okay? And they're going to do this again for 10 years, 20 times. And then they're going to give the bondholders the $300,000 at the end of the 10-year period. That's fine, but for recording, when you sell at a discount or a premium, book-wise, you cannot use that number. When you have a discount, it actually increases your interest expense that you record to match the market value, the market rate, okay? The reason bonds sell at a discount is the rate that's offered by the company is less than the market rate, which would be the going rate elsewhere in the marketplace. Same thing if there's a premium. If there's a premium, you're paying more than that marketplace rate. So you would have to lower the interest expense down to the market. Okay? That's something that probably a complicating factor in all of this. Okay? You have to think about that when there's a discount or a premium. So that's why they asked this question. So how we get this $28,500? First of all, we know we're amortizing that discount $2,250 every 6 months, or $4,500 per year, okay? Plus the annual payments of 8%, 4% every 6 months is $24,000. That's $300,000 times the full 8% per year. $24,000 and $4,500 for the 2 amortizations of the discount. You have to actually record, if you're this company, $28,500 worth of interest expense book-wise. So they ask you that question here in requirement 2. In requirement 2, they want us to record the June 30th semi-annual interest payment and amortization of the discount. They only want 1, but even if you had to do all 20, they would look exactly the same. That's the good thing about straight line amortization, it doesn't change. So here's our interest expense, okay? And you can see this is times 2, right? The 28.5. This is just for 6 months. There's the 22.50. That's this one right here. Plus the 12,000, 14,250. Notice it's more than what they're paying. That's because when you have a discount, it raises up the interest expense you can take up to what everybody else is doing in the marketplace. It's kind of fair. They're leveling the playing field. This is the IRS's great idea, and it works good. It works well, I should say. We'll notice in the next video we have a premium. We're going to be lowering it. by the amortization of the premium. So that's where the $14,250 comes in. Here's our credit of the discount on bonds payable. That's was actually our third amortization of the discount. And then here's the cash, $12,000. So although you pay what you say you're going to pay, what is in the bond, whatever the rate, the coupon rate, the stated rate, there's so many things they call it. This book likes to call it the stated rate a lot. I've seen coupon rate, but there's like 3 or 4 different things that they call it. But anyway, they mostly like the stated, whatever's stated in the bond. And that's the 8% per year. So that's really all we need here. I explained about where they got the $36,000 that's left to be amortized. And this bond has 8 more years to go to maturity. So I think that's about it. Yes, finito. Okay, give me a few minutes to set up the last video and I'll be back shortly.